And you are welcome to use your microphone if you have one and you'd like to, or you can type your questions in the chat there. That's fine too. I'll keep that up on the bottom of the screen.
Hi. My problem is mainly I took accounting 1 in the fall of 2000, and now I'm taking accounting 2 as I come back to school, and it's a prerequisite class. And the lingo, I mean, honestly, starting at chapter 1, I mean, the formulas, the lingo, where I'm getting certain numbers that I need to use in certain equations. I mean, it's all kind of just running together. And I went through the working of the problems, you know, and even when I try to get, like, sometimes I get the predetermined rate correct, and sometimes I won't. It's just, I'm just all over the place.
Okay, that's fair. So why don't we do this for now then? And of course we can shift gears if we find that, you know, we're talking about something you guys aren't struggling with, or we need to shift gears. So maybe if we just look at sort of some stuff right from the beginning of chapter 1 in terms of coming up with our cost classifications, putting things in the right buckets. Maybe if we just start there and see how we feel about that, and then maybe go from there, that might hopefully help.
Okay, yeah, sounds good.
Okay, so I'll keep some of my practice stuff up on the screen here so you can see it, and then I'll sort of talk through it, and you guys can jump in as much or as little as you'd like, and we'll just kind of do this very, very free range here. So the biggest parts of chapter 1 are making sure we understand the difference between direct and indirect costs, and then product versus period costs, right? Manufacturing and non-manufacturing, and really everything that fits within those classifications as well. So for example, this exercise 1-2 that I have here on the screen from the textbook, this gives us an example company that makes custom computers from various manufacturers. Small company, we have an assembly shop and a retail sales store, in the same facility out in Washington. And so we've got a bunch of costs listed here, and we want to determine if those are considered direct materials, direct labor, manufacturing overhead, or selling and admin. And just to recap really quickly, right, those first three, right, direct materials, direct labor, whoops, I don't want to highlight. Sorry, direct materials, direct labor, manufacturing overhead. Those three are what we consider our manufacturing or product costs, right? And then selling and admin fall under that separate bucket of non-manufacturing, aka period costs. And if we think about some of the things we did in chapter 1, the big difference between those two buckets was that our manufacturing costs, those three again here, are called inventoriable costs because the costs flow through inventory. Okay? Whereas our selling and admin costs, or our period costs, we expense on the income statement in the period in which they're incurred. So that's the first kind of big differentiation between cost buckets. Then within cost buckets, again, and we're going to do that in this problem, we want to make sure we distinguish between direct materials, direct labor, overhead, and then if it's a period cost, selling or admin. Okay? So let's just take a look at a few here and then go from there. So the first one says the cost of a hard drive installed in a computer. So right off the bat, we know that particular cost is associated with something that goes directly into our finished product, right? We're in the business of making computers. So anything that's physically becoming part of the product and is easy to trace to that individual product, we're going to consider that some kind of direct cost, first of all, and some kind of manufacturing or product cost. Right? It is associated with our production process. Again, in this case, it's becoming part of our finished good. So it has to be some kind of manufacturing cost. So our three choices there are direct materials, direct labor, and overhead. And fortunately, this one, there isn't a lot of debate about, right? It's definitely a material, and we can trace it easily to the finished product. So that must be a direct material.
Mm-hmm.
Okay. The second one, then, the cost of advertising in the Puget Sound computer user newspaper. So advertising, right, we kind of can start by saying, well, it's not associated with the production process. Right? It's not a cost we incur to get our product ready to sell. It's a cost of actually selling the product. So we can scratch off those first three. It's not a manufacturing cost or a product cost. So it has to be selling or admin. And again, we're talking about advertising. So really that is a cost of selling, right? It's a cost we incur to hopefully entice people to buy our product. So we'd call number 2 there a selling cost. The third one here, the wages of employees who assemble computers from components. Okay, so wages right off the bat, we know that's some kind of product cost, right? Because these people in particular are involved in our production process. So it has to be one of our manufacturing costs. And then our question becomes, well, is it direct labor or is it indirect labor, which becomes part of overhead? In this case, we're saying, well, these are the people who actually assemble the finished computers. So we can trace their labor pretty easily to the finished product. So we want to call that one direct labor. Okay. 4 is a different kind of wage, if you will. Sales commissions paid to the company's salespeople. So again, our first question is, does this have anything to do with the production process? The answer is no. So it's got to be some kind of period cost, either selling or admin. And in this case, again, we're saying, well, a sales commission is incurred to drive sales. So we might as well call that a selling cost. Number 5, and then I'll pause for a moment, the salary of the assembly shop supervisor. So first question again, does that particular cost have anything to do with the production process? In this case, yes, it does, right? The assembly shop supervisor is overseeing the production process. So their salary is a product cost or a manufacturing cost. So then it becomes a question of, well, is it direct materials? No, because it's a wage of an employee. So is it direct labor or indirect labor? And this one we want to be just a little careful. We can't really trace a supervisor's salary to individual products because they're probably overseeing a whole bunch of different product lines that are being produced in the same factory, right? A whole bunch of different things going on at one time. So really their salary is probably indirect labor, in which case we consider that part of manufacturing overhead. Okay, so to kind of recap a little bit of what we've been saying for those first 5, in my humble opinion, it's often beneficial to ask that first question. So is this cost associated with our production process at all? Is it happening in and around the factory building if I'm making something? If the answer to that is yes, it has to be one of my 3 product costs, either direct materials, direct labor, or manufacturing overhead. If it's not associated with that production process, it's going to be one of my period costs, either selling or admin. Then at that second level, if I've determined that it's a product cost, direct materials, direct labor, or manufacturing overhead, I can ask, is it a direct or an indirect cost? By that we mean, is it easily or reasonably traceable to individual products and individual units of product? If it is, then we'd consider it some kind of direct cost, and then it would become direct materials or direct labor. If it's not, we'd consider it an indirect cost. And the good news is all of our indirect manufacturing costs get dumped into that manufacturing overhead bucket. So that second question sort of seals the deal for us, right? If we determine it's direct, well, it has to be direct materials or direct labor. If we determine it's indirect, well, then it has to be manufacturing overhead. That's sort of that catch-all for all of the indirect manufacturing costs. So I'll stop there for a moment and see if there's anything we need to either revisit or reframe from that part of the discussion.
No, but that was very helpful, just the way you was breaking it down where each cost is incurred at.
Okay, good. Well, let me finish out these last three then, just to kind of make sure we're okay there. So number 6 was the salary of the company's accountant. So again, we'll ask, well, is it part of the manufacturing process? Is it going on in and around the factory? So the answer there is no, right? So then it has to be selling or admin. Salary of accountants, well, that's not incurred to sell products. It's not driving sales. So that falls under that admin cost in our period costs. Number 7 said depreciation on equipment used to test assembled computers before release to customers. So we can ask again, is that going on in and around the factory? Is it helping to get our product ready to sell? So this one's a little bit tricky in the sense that we're saying the computer's already finished and we're testing them for presumably some kind of quality. But the key is they're not ready to sell to customers until this testing has been done. So we would definitely call that a manufacturing or product cost, in which case it becomes direct materials, direct labor, or overhead. Okay. So then that second level of question, well, it's not a direct cost, right? And it's not a material, nothing's getting added to the product here. It's not labor because we're not talking about someone working on that testing process. It's just the depreciation on that testing equipment. So that's an indirect cost of production, and we'll dump that into manufacturing overhead. And then last but not least, we have number 8, which said the cost of the rent on the facility in the industrial park. And just to refresh our memory here, we have our assembly shop and our retail sales store in the same facility. So we'll be a little bit careful with this one. So rent on the facility in that industrial park, is that associated with the production process? Well, part of it is, right? We have the assembly shop in there. We also have the retail sales store though. So really this number 8 is both a product and a period cost, both a manufacturing and a non-manufacturing cost. So half roughly, or however we'd allocate that, of that cost is associated with production, and that would become part of manufacturing overhead. The other half, if you will, would be a cost of selling because we have our retail sales store in that same facility. It's a cost that's driving sales. Do all those make sense then?
Can you do the rent on the facility again? I mean, I understand
Sure.
how the costs are split, but are you saying would you actually take that amount and split it down the middle, or?
Yes, I am. So we'd have to know a little bit more about how the space is allocated, right? But for our purposes, let's just assume it's half and half.
Okay.
Like literally half the building is the shop and half is the storefront. So if my rent was $1,000, I am literally saying I'd take $500 and that would become part of manufacturing overhead. And then the other $500 I would treat as a selling cost related to that retail front.
And that would end up being listed as a rent expense, the part for the selling and administration, right?
That is correct. Yep. And that would hit that part would hit the income statement directly, right? And then the half that hit manufacturing overhead would flow through inventory costs and eventually out through cost of goods sold. And I feel like I saw, let me make sure my thing's working here. Randolph, did you have a question?
Yes, I do. When it comes to T accounts and logging it in like that, as far as number 7 and number 8, when you depreciation, you said depreciation was going to go to what is it, direct materials?
Depreciation is going to manufacturing overhead. Yep.
Okay. Would that be a credit or a debit?
Yeah, good question. So what we'd have here is if we looked at our manufacturing overhead account, right, we said that the debits on the manufacturing overhead account were accumulated or actual overhead costs, and the credits were applied overhead, right? If this was a very rough T account called manufacturing overhead. So in my depreciation example for that testing equipment, I would see a debit, or excuse me, I don't need to write debit out, I guess. I'd see a debit to manufacturing overhead for whatever we're calling this number, and then a credit to accumulated depreciation testing equipment for that same 1,000, right? So that is one thing that's different from accounting 120 is when we have depreciation, if it's depreciation on factory stuff, we don't see the account depreciation expense. We dump that into overhead first. It has to flow through our inventory costs. If we had depreciation related to sales equipment or sales facilities, then we'd see our classic depreciation expense.
All right. And for number 8, since you're splitting the two, how would you note that?
Yeah, so in that case, we might have an entry that looks something like what we said it was half and half roughly. So I might have 500 to manufacturing overhead for the assembly shop rent and 500 to run expense for that sales part. And then I'd have a credit to cash, AP, however I was paying for that for the full 1,000.
All right. And I also, when I was listening to you, you said accumulated is always going to be debit and applied is going to always be credit. When they mention that with like the wording of the questions and stuff like that?
No, typically it won't. So we will know which direction the cost is going and what's happening, but we won't typically say that we're accumulating overhead costs. Instead, it'll be things like, number 7, where it just says, hey, here's a cost. It's sort of on us to know that, well, it's an overhead cost. So if it's an accumulated or actual cost, I need to get it on the debit side, if that makes sense.
Yes.
Okay.
All right. Thank you.
Sure. And then while we're talking about the overhead account here, this is not in Chapter 1. I guess it really doesn't come in until late in Chapter 2. But remember, at the end of every period, we want to make sure we get the overhead account balance to 0, right? So we're going to end up with that potentially under or over applied overhead. But overhead is a temporary account. You don't see it on the balance sheet, just to be clear there. Any other questions there from our cost classification or our small sidebar here on overheads?
Leave that screen up a little bit longer.
Oh, sure. Any other questions while we're thinking on that for a moment?
Not at the moment.
Okay. Well, with that, I'll kind of ask again if that discussion prompted any other questions that you all have. I mean, I'm happy to move on to something else sort of my choosing if you don't, but if you have specific questions, I would rather go there to make sure we get those answered for you. Going once.
I'm good. We can move on if
So I'll scroll through Chapter 1 exercises here to kind of see if there's anything else that sparks any discussion for us. So we did talk about our different classifications with regard to product versus period, manufacturing versus non-manufacturing in the subcategories. But one thing we didn't incorporate in that last piece was cost behavior. So I might as well spend a minute on that, and then if you have additional questions, we can certainly revisit those. So that was another big piece of Chapter 1, and really those concepts then get put to use in every future chapter, really the rest of the semester. this idea that some costs behave differently than others. So we had those really three categories of costs, fixed, variable, and mixed, where mixed meant part of it was fixed and part was variable. So one thing that I find at a fundamental level that's helpful to keep in mind or remember is what happens to costs on a total and per unit basis when we say they're variable versus fixed. Because really that can be easy to get turned around, and then you end up sort of analyzing things in a slightly incorrect way. So when we say a cost is variable, we mean that in total, that cost changes with changes in activity, right? On a per unit basis, though, a variable cost remains constant, or that's the assumption we typically make, unless we have some information to indicate that's not the case. So things like direct materials and direct labor are almost always variable, right? The more computers we make in our earlier example, the more hard drives we're going to need. So that direct material cost is certainly variable, and it's proportional to the number of computers I make. Right? But on a per unit basis, the cost of each hard drive is relatively constant. It's not changing, at least not within a short window of time. Fixed costs, on the other hand, in total, they remain constant within some relevant range, right? And then on a per unit basis, we'd say, well, they decrease, but it's not really proportional. And it's sort of a weird exponential or logarithmic almost type function. Because we're really just saying, well, we're spreading those fixed costs out over a greater number of units. So on a per unit or average basis, it's changing, but that change isn't necessarily proportional to that change in activity. And then again, mix, we say, well, that's just almost all bets are off. It's a combo of mixed and, of fixed, if I could type, and variable costs. Okay, part of it's fixed, part of it's variable. So let's just glance at this exercise 1.4, which made use of a few of these concepts and talk about that for a minute. So this said an Espresso Express operates a whole bunch of coffee stands. The fixed weekly expense of a coffee stand is $1,200, and the variable cost per cup is 22 cents. So they want us to fill in this following table here with our estimates of the company's total cost and average cost per cup of coffee at these different levels of activity. We're going to round off to a 1/10 of a cent if we need to. So I'll keep this up and just kind of pull it down here. So we had the fixed component, the variable component, total, and then average per cup. And we're going to do that 2,000, 2,100, and 2,200 cups. So fixed cost, we only have one to worry about. It said the fixed weekly expense of the coffee stand, we'll just assume that's, say, rent, is $1,200. So at 2,000 cups of coffee served in a week, that's going to be $1,200. At 2,100 cups of coffee, that's going to be, you got it, $1,200. And at 2,200 cups, that's going to be, you got it, $1,200. And just to kind of be explicit about what we're saying here, at a level of 0 cups of coffee served, that's going to be $1,200. Got to pay my rent even if I don't ever open the store, for example. Now the variable cost, we said, changes in total in direct proportion to changes in activity. And on a per unit basis, it stays the same. So we know that our variable cost per cup, so that's coffee grinds, whatever else, sugar, is 22 cents per cup. So at 2,000 cups of coffee, that total variable cost is 22 cents times the 2,000. Comes out to 440. Similar idea for 2,100 cups. It's the same 22 cents per cup times 2,100 cups. So now we're saying that's $462. And then again, same deal at 2,200 cups, it's 22 cents per cup times the 2,200 cups. So our fixed costs didn't change at all. We're assuming we're still in the relevant range here. And then our variable costs changed in total in proportion to that change in activity. So our total cost then is just our fixed plus our variable. And I'm going to shortcut and drag my sum across here and just add a little subtotal bar there. So total cost, again, fixed plus variable. So then average per cup, well, that's my total cost divided by my total cups of coffee. So in this first case, 2,000. Second column here for 2,100 cups. Well, that's my total cost, 1,662, divided now by 2,100 cups, 79.1 cents. And then over here on the far right, that's my total cost, 1,684, divided by 2,200 cups, or 76.5 cents. Okay. And so they asked us as a follow-up, does the average cost per cup increase, decrease, remain the same? Explain. Well, that gets to the heart of our cost behavior principles. The average cup is decreasing because fixed costs are staying the same. And we now have more units of product to spread those fixed costs over. Right? Variable costs are staying the same on a per unit basis. So the average would stay the same otherwise. But we're saying, well, I get to spread my fixed cost of $1,200 over more and more cups of coffee as I move left to right here. So the average per cup decreases a little bit each time. Does anyone have questions there on sort of the fundamentals of fixed and variable costs?
No, but I wish accounting remained that simple.
Oh, but then we wouldn't have any more chapters to read in the book. So.
Exactly. That's math. I love math.
Okay.
I hate accounting.
That's fair. Okay. Any other questions here on cost behavior for now?
No.
Yeah.
Anyone else? Okay. We did have a few other terms that were introduced in Chapter 1. I definitely would encourage you to review those. And I'll talk about them just for a minute since they're sitting up here on the screen. So we did talk about these things called differential costs, sunk costs, and opportunity costs. And just to recap the definitions briefly, differential costs, right, were any costs that were, oops, I forget it always tries to make me highlight, apologize. Differential costs are any costs that are different between two alternatives. So we have to be facing some decision, right? Decision whether we want to replace a machine, build a new store, maybe put those in those contexts for Chapter 1. So differential costs were any costs that just differed, as the name would imply, between our two or more choice options. Sunk costs are a big one for accountants. Sunk costs are any historical cost that can't be changed with any decision we make going forward, right? And in the context of replacing machinery, which is one of the things we kept talking about in Chapter 1, sunk costs were things like the cost of the old machine that we were thinking about replacing. Remember, a cost becomes sunk the minute we incur it, basically, right? I can't change what I paid for the old machine I'm thinking about replacing with anything I do going forward. So that cost should become irrelevant in any future decision making. I can't do anything to change it. or take it back, so I might as well ignore it. And then this third one, opportunity cost, that was sort of a special category in its own right. And we said an opportunity cost was the cost of, or the benefit, excuse me, that I'm giving up by pursuing one alternative over another. Right? It was the cost of choosing one option versus the second. So in the context of replacing our machinery or choosing to make a product versus buy it, it was whatever cost was associated with something I was not doing to pursue the other course of action. And I know I'm speaking in very vague terms just as a sort of precursor to those definitions, but while it was up here, I just wanted to mention it. So I would encourage you to go through those a little bit, kind of on your own as well. And if you have questions now, I'm happy to answer them. But otherwise, I'd say just kind of review those and make sure you feel pretty good about what they mean.
No, I do understand those.
Okay. Okay. Did anyone have any questions from Chapter 1 that came about as we were talking the last few minutes here?
No.
Okay. I can move on then, if we'd like here. Maybe take a peek at some Chapter 2 stuff. See if there's anything in there that you all want to focus on. Oops. Actually, let me skip ahead to the exercises. Yeah, so in Chapter 2, we spent a lot of time coming up with predetermined overhead rates and then applying overhead costs to jobs. And so this is one that I often do get a lot of questions about. And so unless there are strong objections, I'll work through exercise 2.1 and 2.2 here. And then we can even do some additional practice for that if you
All right.
would like
I
to.
have
Oh, sure.
questions as far as with 2. What my teacher did on 3, Chapter 3, he had a kind of like a formula when he moved through. Let's say you had, well, let's say direct maintenance, direct labor, and you have the manufacturer overhead. You know, you have like plus, minus, and so on and so on. And you came out to the sum of what you needed to be at. You know what I'm saying? You understand what I'm saying?
So we're adding those up to come up with what's my bottom line in that?
Yeah, but you know, I'm looking for like more of a calculation type of thing, a formula cheat sheet type of thing, you know?
Oh, okay.
You know, remembering what's going to, happen for every problem is different, you know?
Sure. So if I'm not mistaken, I believe what you're referring to is related to calculations for cost of goods manufactured in our schedule of cost of goods manufactured.
Yes, yeah, something like that.
Okay. So if it's all right, I'll keep that in mind and we'll come back to it in just a couple minutes.
Okay.
Okay, perfect. So predetermined overhead rates and applying overhead to jobs. Again, this was pretty fundamental to Chapter 2. And the good news is we do it really the same way every time. It just sometimes looks a little different. So in 2-1, we had to come up with a plant-wide predetermined overhead rate for the entire year. And we're told that our company here, Harris Fabrics, calculates that on the basis of direct labor hours. Remember, we can have a whole bunch of different activity bases that we'll see. So direct labor hours is one, machine hours, direct labor cost. And it's almost an infinite number of possibilities, but usually we stick to those 3, maybe a couple other. So at the beginning of the year for Harris here, we estimate 20,000 direct labor hours would be required for the estimated level of production. We also estimate 94,000 in fixed overhead for the coming period and variable overhead of $2 per labor hour. Harris's actual overhead for the year was $123,900 and its actual direct labor was 21,000 hours. So we're going to calculate the plant-wide predetermined overhead rate for the year. Okay. So to do that, we need to make sure that we account for the fixed and the variable overhead. So we said our estimated fixed overhead was $94,000. Our estimated variable overhead was $2 per labor hour, and we expected to run or incur 20,000 labor hours at our current expected level of production. So our total variable overhead is estimated then at $40,000. Again, this was the fixed overhead. Okay. So our total estimated overhead for the whole year, variable and fixed, becomes the sum of those two, 134,000. I'll just put total overhead. And then
where'd you get the variable overhead rate?
Oh, sure. So this was the $2 estimated variable overhead per labor hour times the 20,000 labor hours that we expected to run.
Okay.
And again, one thing to keep in mind for our predetermined overhead rate calculations, we're always dealing in estimates because we're doing this theoretically at the beginning of the period where we don't know for sure what's going to happen. So we're always basing these estimates on what we think is going to happen as far as activity goes. Okay. So our total overhead estimated at $134,000. So to come up with a predetermined overhead rate, we say, well, what's my total estimated overhead, $134,000, divided by my total estimated activity of 20,000 direct labor hours. Okay. Always an estimate divided by another estimate. Don't have any actual numbers involved because, again, we're coming up with our predetermined overhead rate. So when I crunch that, we get, blow out the decimal here, $6.70, and that's per labor hour. Because, again, that was our allocation base that we're working with. We want to represent those overhead costs as a function of per labor hour.
I'm sorry, I was writing. Can you go back to how you got the 6.7?
Sure. You're fine. So that's the total estimated overhead here of 134,000 variable and fixed.
Okay.
Divided by our estimated activity of 20,000 direct labor hours. So it's always our total estimated cost divided by our total estimated activity.
Okay. So you have to get the total. As this is where accounting trips me up. So you got to get the total estimated hours or overhead, and you divide that by the total labor.
Correct. Yep. So total estimated cost, overhead, divided by total estimated activity. And the good news is we always calculate our predetermined overhead rates this exact same way here. So even if it looks different or if we have to worry about fixed and variable separate or anything like that, at a fundamental level, we always need to say, what's my total estimated overhead cost and what's my total estimated activity? That's how I'm going to come up with my predetermined overhead rate. Every time, okay?
Yes.
Jasmine, did you have a question?
Yes, I see that you're using Excel. I was wondering if we can use Excel and put this information just how you're putting the information in. Is there an equation that we can just look up in Excel to do the work for us?
So for things like predetermined overhead rates and applied overhead and such, there is not.
Okay.
Yeah, there aren't like the function wizard. There isn't a management accounting one for overhead stuff. It does rely on us kind of remembering the components of it.
Okay.
Okay.
Yeah.
Okay, so 2-1, that's all they wanted. But while we're here, I'm going to extend 2-1 to illustrate sort of a point for us. Okay, so there was our predetermined overhead rate. let's think about applied overhead for a minute. Okay. Applied overhead, we always calculate as our predetermined overhead rate. Again, I apologize for my typing. Sometimes it's out of hand. Times, I'll use X for that, my actual activity. Okay. Remember, applied overhead, we want to say, what is my predetermined overhead rate? I want to factor that by what I actually did with regard to that activity base. So applied overhead in this case then is going to be my predetermined rate, $6.70 per labor hour, times my actual activity, which we were told was actual total direct labor, 21,000 hours. Okay, I won't hit enter on that yet. Again, applied overhead, always my predetermined overhead rate, now times my actual activity. So $6.70 here times the actual labor hours of 21,000 means Harris Company here would apply $140,700 in overhead cost for this particular period. Okay. So to continue that on just another second here, we were also told that our actual overhead for the year, I'm going to wave my cursor over it, was $123,900. So now I can come up with a number for under or over applied overhead, right? Because those two numbers are different. My applied overhead was $140,700. My actual overhead incurred was $123,900. So my overhead in this case is over applied, right? I applied more than I incurred. So if I take the difference between those two, and I'll do the numbers out here in the formula just to be more explicit, 140,700 minus my actual overhead incurred of 123,900. That means my overhead was over applied by $16,800. Okay. And this fits in again with sort of what we looked at earlier with that manufacturing overhead T account. Remember, our actual overhead were our debits to the overhead account. Our applied overhead was our credit side. At the end of the month, we want to get that to zero. So I've over applied my overhead in this case by $16,800. I'd have to create an entry to close that out, if you will, to either cost of goods sold or those WIP finished goods and cost of goods sold accounts. That was later on in chapter 2 and beginning of 3.
Yeah, I want to address that when we get to that part too.
Sure, yeah, absolutely. Any other questions here though for now in terms of my predetermined overhead rate, coming up with applied overhead, and then determining whether I'm under or over applied? Very, very critical.
Okay. Just want to make sure I got all my dots connected.
Sure. Or similarly, while we're thinking about that for a minute, are there other things beside that disposition of over-applied overhead that come up as we talk about this that we need to discuss anything further?
No,
Okay.
I'm good.
Because I would say if you know I'm a betting person, I can, well, I don't even have to bet. I can guarantee on exams, you know, you certainly will need to be able to come up with predetermined overhead rates. You'll need to come up with applied overheads, and you'll need to come up with under over applied overhead. Okay, so if I move on for a minute in chapter 2 anyway, we had things like coming up with total job costs and unit product costs.
Yes, like doing that. Like I know on some of the homework and testing or examples, you'll do it for a year, but then you'll also break it down and do it for like a specific job.
Yeah. Yeah, so let's look at 2.3 because that's a nice brief job costing example, but it hits all the sort of important points. So this said, I guess I can read this up here. Mickley Company's plant-wide predetermined overhead rate is $14 per direct labor hour, and its direct labor wage rate is $17 per hour. Following information pertains to job A500. So that thing incurred $231 in direct materials cost and $153 in direct labor. And requirement 1 says, well, what's the total manufacturing cost assigned to job A500? So the nice thing, for better or worse maybe, is that total manufacturing cost hopefully starts to trigger in our mind, well, what the heck gets included as a manufacturing cost? We know it's direct materials, direct labor, and then manufacturing overhead. Okay, so anytime we see, well, what's the total manufacturing cost? Or if they say total product cost or inventoriable cost, it's always these 3 items: direct materials, direct labor, manufacturing overhead. So in this case, they gave us materials and they gave us the total labor cost, but they didn't give us manufacturing overhead. So now we just have to determine, how can I apply overhead to this particular job? Well, I know that my predetermined overhead rate is $14 per direct labor hour. So I'll put that over here. MO, $14 per direct labor hour. Well, how many direct labor hours did job A500 incur? I don't know that right off the bat because I only know the total cost was $153, but I do know that the labor wage rate is $17 per hour, right? So if I say, well, $153 in labor cost divided by $17 per labor hour means this job must have incurred 9 hours in direct labor. Okay, nice even 9. So then when it comes time to apply overhead, I can say, well, my predetermined overhead rate was $14 per labor hour. And now I know that this thing incurred 9 hours of direct labor. So $14 times the 9 hours means I'm going to apply $126 in overhead to this particular job. And then I have now all 3 of my manufacturing costs. So if I add those up, materials, labor, overhead, I get a total cost of the job here of $510. Now the second part, it just said, well, if job A500 consists of 40 units, what's the unit product cost? Nothing super fancy there. We just want to say, well, $510 was the total cost of the job divided by the 40 units that are included in that job means the per unit cost was $12.75.
Wait, how did you get the $9 for the direct labor?
Okay, yeah, this was 9 hours, sorry.
Oh, 9
Yep.
hours.
So that's the total labor cost of $153 divided by the $17 per hour that I know my labor wage rate to be.
Okay.
Okay, so 153 bucks in cost divided by $17 per hour means I must have incurred as part of this job 9 hours. And then I used that actual activity to apply overhead here. $14 per direct labor hour was my overhead rate times those 9 hours actually incurred. And there's my applied overhead cost of $126.
Okay, got it.
And then again, just to recap that last step here. So I add the 3 up to get my total cost, direct materials, direct labor, manufacturing overhead. And then in this case, I also wanted a per unit cost. So I just had to divide that total cost by the number of units, 40, to come up with this $12.75 per unit cost. Okay, any other questions here on job costing?
No, just stay there for a second, though.
Absolutely.
Those tools given. So in E49 where you got MO equals 14 divided by the direct labor hours, you're saying the materials, the direct materials.
Oh yeah, sorry. So this is per direct labor hour. So this was our given predetermined overhead rate. Yeah, sorry about that. Should label that better. So that $14 was our plant-wide predetermined overhead rate for Mickley here. We didn't calculate that.
Okay. So that I was given direct materials and the predetermined overhead rate.
In this case, it was. Yep.
Yeah.
Now on a test scenario, right, since we know how to calculate predetermined rates, you might have to do it yourself, right?
So to calculate costs.
Okay. Other things here from our job costing exercise.
What is MO? What is MO an abbreviation of?
Oh, manufacturing overhead.
Okay.
Yep. So in chapter 2, there was a lot of that job order costing. And again, even when it looked and felt a bit different, fundamentally, it's a matter of coming up with these individual product costs for particular jobs and applying what we know about how to apply overhead to those particular scenarios. So if you feel good about a couple of these, you know, give yourself a little bit of a test, so to speak, and try a couple on your own too to see like, hey, can I come up with this total job cost? Kind of revisit some of your homework stuff to really make sure you can get to those numbers. Or that would be my suggestion anyway.
Yeah, I'm ready to try some examples. I hope this is going the way it seems.
Okay. And then also in chapter 2, so we already talked about predetermined overhead rates and applying overhead. Really, that kind of took us to the end. If I flip ahead here. most of this stuff was kind of different iterations of the same concept. So really the big stuff in Chapter 2 was coming up with predetermined overhead rates, applying overhead, and then coming up with total costs of jobs. So I'll slide ahead to Chapter 3 a little bit here. And we'll kind of see how we feel about some of this stuff. So Chapter 3, well, there were several big things going on. Fortunately, some of it was extensions of Chapter 2, but the new thing, or mostly new thing, was a lot of our journal entries in the flow of costs through our costing system. So now we were saying, well, this is all fine and dandy. We know how to represent these costs. We know what they are. And now we need to account for them in the books, basically, right? So we looked at journal entries of how to record, materials purchases, materials that were used, labor, overhead costs, and then how those things flowed through our inventory accounts and eventually out through cost of goods sold. So that is a huge component of Chapter 3. So I may run through a few of these journal entries here, and then we can see, which ones we feel good about, which ones we don't. There we go. Okay, so exercise 3.1, for example, said, well, Larned Corp recorded the following transactions for this particular recently completed month. We bought some raw materials, we used some in production, did a whole bunch of other things. So let's see if we can book some journal entries for these things. So letter A said, well, $80,000 in raw materials were purchased on account. So we know that raw materials is an inventory account, right? It's an asset. It has a ending balance on the balance sheet if we have any materials left over. So to increase that account, we want to debit it, in this case for $80,000. And now we need a credit to go with that. Well, how did we pay for these things? We didn't pay in cash. We bought them on account. So thinking back even maybe to accounting 120, accounts payable is a applicable credit there, or a reasonable credit. If we had paid cash, we'd just substitute cash in here for accounts payable. Okay, so all I did was purchase some raw materials on account. Now B said 71,000 raw materials were used in production. Of that, 62,000 was for direct materials and the rest was for indirect materials. So I'm actually going to start with the very last part of this entry, and it's the first part of the text here. 71,000 in raw materials were used in production. So I know no matter what else happens, I've decreased my raw materials balance by $71,000, right? Used in production. So they're no longer raw materials. They're part of my goods that are being produced. They're not in the raw material pile anymore. So now I need some matching debits. What else do I know here? Of the amount that was used, 62,000 was for direct materials and the rest was for indirect materials. So thinking back to my definitions and my cost classifications, direct materials was a product cost, and we said all of our indirect materials get dumped into manufacturing overhead, right? So in this case, I would say, well, the 62,000 in direct materials needs to get debited directly to work in progress or work in process. We use those terms interchangeably. And the other debit is to that manufacturing overhead account. And that's the difference between my total of materials used and my direct materials accounted for here. Again, anything I'm doing now to account for cost, I need to pay attention to whether it's a direct or indirect cost, and that'll affect whether it hits manufacturing overhead or work in process directly. So if I move ahead to C here, a similar situation, but this time using labor. So total labor wages of 112,000 were paid in cash. Of this amount, 101,000 was for direct labor, and the remainder was for indirect labor. So one more time, I'm going to start with the last entry and say, well, we know we paid cash, so we don't need wages payable or anything like that. 112,000. Of that amount, 101,000 was for direct labor, and the rest, the other 11,000, was for indirect labor. So now we just need to decide where those costs go. Well, all of our indirect costs, we said, go to manufacturing overhead. So that indirect labor goes into manufacturing overhead. All of our direct costs go into work in process or work in progress, whichever term we want to use. So those direct labor wages, right to work in process on the debit side. So again, anytime I'm accounting for manufacturing costs here, I need to say, well, are they in fact manufacturing costs, direct costs, or are they indirect costs? They need to hit manufacturing overhead first. In this case, we had some of both. Some of our materials were direct, some were indirect. Some of our labor was direct, some of it was indirect. Let's see what else we had here. So D was depreciation of 175,000 was incurred on factory equipment. We did an entry like this the first few minutes of our Q&A here. Remember, depreciation on factory equipment is a manufacturing cost. It's an indirect cost. So we would debit manufacturing overhead for 175,000. And then we'd land a credit to accumulated depreciation factory equipment or something like that for the same 175,000. Remember, if it's something happening in and around the factory, we're not going to expense it. We're not going to see depreciation expense. We want to make sure that cost flows through manufacturing overhead.
Pause right there for a second. I'm trying to write that down.
Oh, sure. And then just to highlight what we did in C, since that's still on the screen here too, we had total labor of this 112. When it comes to journal entries and T accounts, we just need to make sure we're separating the direct and indirect costs. Anything indirect needs to hit manufacturing overhead. Anything direct needs to go directly to work in process. As we're finishing up with 3.1 here, are there other questions related to it or anything that we talked about in it that have come to mind?
What is the abbreviation AD for?
Oh, sorry. Yep, that's accumulated depreciation.
Oh, okay. Okay. Accumulated depreciation. Oh, okay. And accumulated depreciation is an indirect cost. So that's why it goes into manufacturing overhead.
So depreciation on factory equipment is indirect, and that is why it goes to overhead. Yep. Be careful how you said that part, though. Accumulated depreciation itself is actually one of our weird contra asset accounts, right? It reduces our equipment asset account. But this depreciation cost, you're absolutely right, is an indirect cost, so it needs to hit overhead.
At least for the purposes of this example and what we'll have on our test. When it changes, I'll deal with that later.
Okay, that's fair. The other thing we didn't account for here, maybe I'll just scroll ahead quick to find an example for it. Okay. Here's some more journal entry considerations for us. So this is a different company. They use a job order costing system. They have a bunch of transactions. Some of them are the same ones we did in 3-1, but there's some new ones. I wanted to make sure we had an example of those. Whoops. So let's see here. Yeah, F said the company applies overhead cost of production using a predetermined rate of $8 per machine hour. A total of 30,000 machine hours were used in October. So applied overhead, we always said, was predetermined rate, 8 blocks this time, times our actual activity, 30,000 machine hours here, and that was our total applied overhead. So the question becomes, and we don't talk about this a lot in Chapter 2, where the heck am I applying that cost to? Like, where's it going, in other words? And the answer to that is always going to work in process or work in progress, depending on which term we're using. So when I'm applying overhead, I'm always debiting work in process, and I'm crediting that manufacturing overhead account. In this case, we said, again, that was a predetermined overhead rate of $8 per hour times 30,000 hours for a total of $240,000. And then we don't have to do the calculation again because we're making sure our debits equal our credits. 240,000 credit to manufacturing overhead. So that's something we don't emphasize quite as much in the early parts of Chapter 3 and back in Chapter 2, is where that overhead applied goes. But here we want to make sure we make the point, well, I'm applying that overhead to work in process. It's to these jobs that are being worked on throughout the period. And then to continue to look at our flow of costs, letter G said jobs costing $520,000 according to their job cost sheets were completed during October and transferred to finished goods. Even if it didn't say this very last part, transferred to finished goods, we can assume that's where they're going. Anything that's completed has to be going to finished goods. So when jobs are finished, they're no longer in process, right? So I have to move the costs associated with them out of work in process. So in this case, $520,000 in jobs are now finished. So I'm moving their costs out of work in process with a credit there, and I'm increasing with a debit my finished goods account for that same $520,000. Okay.
If there's not anything else in Chapter 3, would you mind going through this entire problem, like from the raw material, from A through whatever alphabet it goes to, the same way you work through those other ones? I want to just write down all the things that's given so I can.
Oh, sure. Yeah. So let me just continue them under these since we kind of did those ones already.
Okay.
Okay, so we didn't have much of a setup other than to know we're a Polaris company here, and we just had a bunch of transactions. So we'll kind of do these the same way we did F and G. So A just said raw materials purchased on account, 210,000. So we know no matter what else happens, we're increasing our raw materials account by 210,000. Get raw materials as an asset account, increase it with a debit. In this case, we purchased them on account, so we didn't pay cash. So we're going to credit to accounts payable for the same 210,000. Then in part B, we found out that raw materials used in production were 190,000, of which 178,000 were direct, 12,000 considered indirect materials. So again, I'll start at the end, so to speak, and say, well, if we're stuck, let's think about what we know for sure. That's that our raw materials account is decreasing by $190,000 because we're using up $190,000 in materials. Now I know I have direct materials of 178 and indirect materials of 12. I just need to figure out where to put those. So direct cost, we said, well, we'll dump those, directly to work in process. And then any indirect manufacturing costs, we need to push through the manufacturing overhead account. And that's 100% of the time guaranteed. Indirect manufacturing costs need to hit manufacturing overhead. Direct manufacturing costs, we can dump directly into work in process. So let's try a similar thing in C with direct labor cost. It said accrued direct labor cost of 90,000 and indirect labor cost of 110. So we said direct manufacturing costs go directly to work in process. So direct labor, 90,000. Indirect manufacturing costs need to go to manufacturing overhead. So indirect labor, 110,000. And in this case, we said we accrued these costs, so we need some kind of wages payable. Didn't pay for them in cash. So the sum of those two, the 110 and the 90, $200,000. Letter D said depreciation recorded on factory equipment was $40,000. Depreciation on factory equipment. It's associated with the factory and our production process, so it has to be a manufacturing cost. We know that our indirect manufacturing costs are all considered manufacturing overhead. So this depreciation cost, you want to dump into manufacturing overhead as well. $40,000. And again, our credit would be something like accumulated depreciation, factory equipment, or something very close to that. And then letter E, we knew other manufacturing overhead costs accrued during this particular month were $70,000. We don't have to determine whether it's direct or indirect because we know right away it is explicitly manufacturing overhead. So the nice thing there is I know, well, I need a debit to manufacturing overhead for $70,000. It just says these costs have been accrued, not paid. So really we have some kind of general maybe accounts payable to incorporate that whole cost. We don't really know much more about it or what these costs even are. So we'll just say accounts payable is the credit for now. Let me copy F and G down here just to kind of reiterate them quick. Since we're going end to end here. So F said, if we recall, company applies overhead to production using a predetermined rate of $8 per machine hour, and a total of 30,000 machine hours were used in October. So for F, we debited work in process and credited manufacturing overhead for 240,000. And that's the $8 per machine hour times the 30,000 machine hours that were used. And then in letter G, we said jobs costing 520,000, according to their job cost sheets, were completed during October and transferred to finished goods. So we increased finished goods by 520,000 and decreased work in process for the same, just indicating that these jobs have moved, so to speak, from work in process, stuff that's partly done, to finished goods, stuff that's all the way done and ready to sell. And then we have just one more here. Jobs that had cost $480,000 to complete according to their job cost sheets were shipped to customers during the month. These jobs were sold on account at 25% above cost. So we actually have a couple entries to make here. We're selling these things on account, so we need to debit accounts receivable for the sale, and we need to credit our sales revenue account. Now the cost for that is going to be our cost, $480,000, plus the 25% markup above cost. So one way to do that is to say, well, 125% then of our cost is what we're selling these things for. And that's a total of $600,000. The second entry needs to update our inventory. So debit cost of goods sold, and this time we want to make sure our debit is for the cost to us, $480,000 as given there. And then our matching credit this time is finished goods. We want to indicate in our records here, in our books, that $480,000 worth of our jobs, so to speak, have now moved from finished goods out through cost of goods sold. They've been delivered to the customer. Okay, we no longer have those goods. Customer has them. Instead, we have an account receivable for $600,000 and a whole bunch of sales revenue.
Can you go back through those calculations again, please?
Absolutely. Okay, so the sale itself, we said the jobs cost $480,000. So for our inventory update, we didn't do any calculation here. We said, well, those jobs cost us $480,000. That's what they're on our books for. That's what we need to move from finished goods to cost of goods sold. But then for the sale itself, we wanted to book an account receivable and sales revenue for the amount that we would have charged the customer. We were told that we're sold these things at 25% above cost. So another way to think of it is, well, if our cost is $480,000, 25% of that is $120,000, and that would be the markup on those jobs. So if I add that to my cost of $480,000, that's where I get my $600,000. So it's my cost of $480,000,
Okay.
plus the 25% of $480,000 on top of that for what I'm charging the customer. Now it also asked us to do some T accounts for overhead and work in process. Let's at least try to look at overhead here. Try to squeeze this in. A little T account. And I apologize, I'm going to have to do a little scrolling here. So we accumulated some overhead costs back in the beginning here. Oops. We had our indirect materials, 12,000, our indirect labor, 110, and then our other overhead of 40. So I'm going to, and then our other overhead of 70. So I'm going to plug all these in as debits. So that was 12 for indirect materials, 110 for indirect labor. We had the depreciation on the factory equipment and the other overhead costs of 70. So those were all the overhead costs we incurred or accumulated. We also applied overhead back in letter F for $240,000. So I would see a credit here in manufacturing overhead for that $240,000. So that's all that happened in the overhead account for this particular month. So let's total up our debits and credits and then worry about what to do with that. So our total on the credit side is the only entry we have, $240,000. And then on the debit side, I'll just sum these. We had total debits of $232,000. Remember, our debits are our actual or incurred overhead. Our credits are our applied. So in this case, I know my overhead must be over applied. I have $8,000 more in credits than I had in debits. So I'm $8,000 over applied for the month. And to a much earlier question we had that promised we'd get back to at one point, to clean that up at the end of the period, what we need to do is say, well, what entry in overhead gets me to zero? In this case, I need an $8,000 debit to get my debits to equal my credits. So move this out to make sure it's not confusing here. So now I would have 240 in debits to match my 240 in credits. Okay. So my journal entry would be, let me do it underneath here. Debit manufacturing overhead, $8,000. And credit, one of the ways we talked about doing that was to close it out directly to cost of goods sold. Again, I got to the end of the period back up here, and I had $232,000 in debits and overhead. I had $240,000 in credits. So I knew that my overhead for the period was over applied by the difference, or $8,000. So to fix that or to clean it up, I just debit overhead for $8,000. And one of the ways we talked about disposing of that was to just issue one credit to the cost of goods sold account for that same amount. Excuse me, in this case, $8,000. So this would bring my overhead account back to zero. And this would have the effect of reducing my cost of goods sold expense for the period. Does anyone have questions about what we did here with overhead or any of those last journal entries?
I do. Can you scroll back up to the cost of goods? Yeah, the finished goods. Can you click on D101?
Yes.
And can I see the formula on that?
Oh, so this one we didn't calculate actually. Right? This one we said, well, in letter H here, jobs had cost $480,000 to complete.
Yeah.
So we knew those jobs were in finished goods at $480. So I didn't have to calculate anything this particular time.
Okay, it was one of them that you did a calculation on. And it was
Oh,
like,
it was the accounts receivable one here. Yeah.
yeah, it's 125. Okay.
Yeah. So this is where I was saying, well, our cost was the 480. We wanted to add this 25% markup. So if I multiply it by 125%, I can get to my fully marked up price.
All right.
Or if I want, I can add that markup separately if I want to do 25% of the 480 and then add it to my cost.
Mhm.
Same number in the end, just whichever way you feel more comfortable doing it.
In that manufacturing overhead example to the bottom, where'd you get that 70,000 from in D108?
70,000 was letter E. The other manufacturing overhead costs accrued during October. So we had booked this entry here for 70,000 to overhead and 70,000 to accounts payable. And that's where that came from. So this one, the 12,000 was letter C, that was labor. The 110, or excuse me, C was materials. Sorry, 12,000 was B, the materials. 110 was C, the labor. 40 was D, the depreciation. And then 70 was E, the other overhead. And then over here, F was the applied overhead. So I sourced all of those from my journal entries. And as you're doing similar problems, definitely make sure that you go through your journal entries as a second check and make sure you've transferred every single debit and credit you have booked in your journal to the appropriate T accounts. It's very easy to kind of skip or miss one or two. Just always give those a double check and say, did I, book this to the left-hand side of work in process? Did I book this to the left-hand side of overhead? And so on and so on. Because in the case of overhead here, I wouldn't have been able to come up with an under or over applied amount without making sure I'd accounted for all my debits and credits.